Two Jewish immigrants from Germany controlled more American industrial capital than the federal government's entire annual budget. While robber barons fought brutal public battles for market dominance, Jacob Schiff and the Kuhn, Loeb banking house quietly financed the infrastructure that built modern America, then nearly destroyed it through the most sophisticated financial warfare campaign in history. The numbers are breathtaking. By 1910, Kuhn, Loeb Co. had financed over $1.8 billion in American railroad construction, approximately $54 billion in modern money. They controlled the financing for Pennsylvania Railroad, Union Pacific, Baltimore and Ohio, and dozens of smaller lines that moved 60% of American freight. When Americans shipped grain from Kansas to New York, traveled from Chicago to San Francisco, or sent goods from factories to markets, they depended on transportation networks that German Jewish immigrants had financed from their Wall Street headquarters. But what nobody understood was how two men who spoke broken English when they arrived in America gained such unprecedented control over the financial arteries that pumped life through the American economy. Jacob Schiff never built a single mile of track. Abraham Kuhn never operated a single factory. Yet they possessed more influence over American economic development than Andrew Carnegie, John D. Rockefeller, and Cornelius Vanderbilt combined. The secret wasn't just money. It was revolutionary financial engineering that transformed European capital into American industrial dominance. While American banks still thought in terms of local loans and regional investment, Kuhn, Loeb pioneered international bond syndication that sold American corporate debt to European investors hungry for New World returns. They didn't just finance American companies, they created the global capital markets that made American industrial expansion possible. This is the story of how two Jewish refugees became American kingmakers, of European gold that built American infrastructure, and of financial instruments so sophisticated they wouldn't be understood by regulators until decades after their creators were dead. It's a tale of immigrants who understood American potential better than Americans themselves, of foreign capital that made American dreams reality, and of the most dangerous financial warfare campaign ever conducted on American soil. The Kuhn, Loeb legacy shaped every aspect of modern American capitalism. The New York Stock Exchange operates through mechanisms they pioneered. American corporations finance expansion through techniques they invented. Wall Street itself exists in the form that Jacob Schiff designed during 50 years of calculated empire building that transformed a modest German-Jewish partnership into the most powerful financial institution in American history. Yet their story remains hidden because their methods were so controversial. They triggered the creation of the Federal Reserve System, sparked congressional investigations that lasted decades, and generated anti-Semitic conspiracy theories that persist today. By 1920, Jacob Schiff had either created modern American finance or nearly destroyed American economic independence, depending on whether you believed he was a patriotic immigrant or a foreign agent. By the time you finish this story, you'll understand how two Jewish immigrants from Frankfurt built Wall Street's most powerful bank, and why. Their legacy remains so sensitive that major financial institutions still refuse to discuss the techniques that Kuhn Loeb used to control American industrial development for over 50 years. Chapter 1. German Exodus. The letter that changed American financial history arrived at Jacob Schiff's Frankfurt boarding house on April 3, 1865, as Union armies were closing in on Richmond and Abraham Lincoln was preparing for a second term he would never complete. "Come to New York immediately," Abraham Kuhn wrote from his modest Wall Street office. "American industrial opportunities exceed European imagination. German-Jewish expertise essential for developing American capital markets. Partnership offers unlimited potential for European capital coordination with American expansion." The invitation represented everything Jacob had been calculating during 18 years of European financial apprenticeship. At age 38, Jacob had mastered every aspect of international banking while watching European capital markets approach saturation that would limit future growth opportunities. American industrial development was accelerating beyond American domestic capital capacity, while European investors were desperate for the high yields that American expansion could provide but didn't know how to access safely. You see, Jacob's German experience had provided perfect preparation for American opportunities that other European financiers couldn't evaluate accurately. German banking had specialized in international trade finance and currency arbitrage that required sophisticated risk assessment for investments across multiple political jurisdictions. German Jewish bankers had developed expertise in evaluating political risks and managing international capital flows that mainstream European banks couldn't match. Frankfurt's Jewish Quarter had functioned as Europe's most sophisticated international financial center because political restrictions had forced Jewish bankers to develop alternative business models that transcended national boundaries. While Christian bankers remained focused on domestic markets, Jewish financiers had created international networks for capital coordination that enabled investment opportunities across Europe and beyond European territories that domestic banks couldn't access. Jacob's training at M.A. Rothschild & Sohn had exposed him to the most advanced financial techniques in European banking, while providing practical experience in managing international investment portfolios that spanned multiple currencies, political systems, and economic conditions. The Rothschild network had demonstrated that international capital coordination could achieve investment returns that domestic alternatives couldn't match when deployed through superior intelligence networks and risk management expertise. Consider Jacob's situation in 1865. He possessed financial expertise that represented the culmination of centuries of Jewish international banking development, but European markets were becoming increasingly competitive as established Jewish banking houses dominated the most profitable opportunities. American markets offered unlimited expansion potential, but required someone with Jacob's specific combination of international expertise and willingness to accept frontier risks that European banking establishments were avoiding. The decision to emigrate wasn't just professional calculation, it was recognition that Jewish advancement in European banking was approaching limits that anti-Semitic pressure was making increasingly difficult to overcome. German political unification was creating nationalist movements that viewed Jewish banking success as foreign influence threatening German economic independence. Jacob could either remain in Europe and accept declining opportunities or immigrate to America, where Jewish banking expertise would be welcomed rather than resented. Abraham Kuhn's invitation offered Jacob exactly what he needed: partnership with established American operations that could benefit from European expertise while providing Jacob with American market access that individual immigration couldn't have achieved. Kuhn Loeb Co had operated in New York since 1847, but remained a modest regional partnership that lacked the international connections necessary for competing with major American banks for large-scale industrial financing opportunities. The partnership structure was perfect for Jacob's strategic objectives. Kuhn and Loeb would provide American market knowledge and regulatory relationships, while Jacob would contribute European capital connections and international financial expertise. The combination would create competitive advantages that no purely American or purely European bank could match for serving American companies that needed international capital for expansion beyond American domestic financing capabilities. Jacob's arrival in New York on August 6, 1865, coincided with American industrial transformation that would require unprecedented capital coordination for sustainable development. The Civil War had demonstrated American manufacturing capacity, while revealing that American financial infrastructure remained inadequate for coordinating the capital deployment that sustained industrial growth would demand. American banks understood local commercial lending, but lacked expertise in international capital markets that could fund large-scale industrial expansion. Here's what made Jacob's timing perfect. American industrial leaders were discovering that domestic capital markets couldn't provide the sustained financing that modern industrial operations required for competing in international markets. European capital markets possessed the required funding capacity, but needed intermediaries who could structure American investments appropriately for European risk management requirements that American business practices didn't naturally satisfy. The initial challenge was establishing credibility with American industrial leaders who were suspicious of foreign financial involvement that could compromise American business independence. Jacob needed to demonstrate that European capital could strengthen rather than threaten American industrial capabilities, while providing American companies with competitive advantages that domestic financing alone couldn't achieve. Jacob's breakthrough came through recognizing that American railroad development offered perfect opportunities for demonstrating European financial capabilities. American railroads required capital investment at scales that exceeded individual American bank capacity, while providing collateral security that European investors could evaluate through established European railroad investment precedents. Railroad financing would enable Jacob to prove European capital value while building relationships with American industrial leaders who controlled other sectors requiring comparable international financing. The Pennsylvania Railroad Partnership established the template that would make Kuhn Loeb the most powerful bank in America. Jacob provided Pennsylvania Railroad with access to European capital markets that enabled expansion financing at lower interest rates than domestic American banks could offer. European investors received Pennsylvania Railroad bonds that provided higher yields than European alternatives, while offering security backed by American railroad assets that European investment analysis could evaluate confidently. But Jacob's strategy extended beyond individual financing relationships towards systematic development of American capital market infrastructure that would enable routine international investment in American industrial opportunities. Jacob was creating financial instruments and investment procedures that would transform occasional European investment in American companies into systematic European participation in American industrial development that would benefit both European capital and American expansion. European response exceeded Jacob's most optimistic projections. German, British, and Dutch investors were eager for American railroad investment opportunities that provided yields averaging 7 to 8% annually, compared to European alternatives that rarely exceeded 4 to 5% returns. European institutional investors were particularly interested in American railroad bonds because American transportation development offered growth potential that European railroad markets couldn't match as European railroad construction approached completion. But European investment interest also created competitive pressure from established American banks that were losing profitable financing opportunities to European capital that Jacob was channeling toward American companies. American banking establishment viewed European capital as threat to American financial independence that required resistance through political pressure and competitive response that could eliminate foreign advantages in American capital markets. Jacob's response demonstrated sophisticated understanding of American political psychology that would characterize his entire career. Instead of competing with American banks for American business, Jacob positioned European capital as complementary to American banking that would enable American industrial expansion beyond domestic capacity while providing American banks with correspondent relationships that would strengthen American banking capabilities for serving American companies that required both domestic and international financial services. The strategy succeeded because Jacob was absolutely correct about American capital requirements for sustainable industrial development. American industrial expansion was creating financing demands that exceeded American domestic capital capacity while requiring financial expertise that American banks were still developing. European capital was essential for American industrial growth rather than competitive threat to American financial independence. By 1870, 5 years after Jacob's arrival, Kuhn, Loeb Co. had established European capital relationships that provided American railroad companies with access to over $200 million in European investment funds, approximately $4.2 billion in modern money. European investors in Kuhn, Loeb-managed portfolios were earning average annual returns of 9.3%, while American railroad companies were accessing capital at interest rates 2 to 3% below domestic American alternatives. The German Exodus phase had established Jacob as the most effective conduit between European capital and American industrial opportunities, while demonstrating that international financial coordination could accelerate American development beyond domestic possibilities. Jacob had proven that Jewish banking expertise could serve American industrial expansion while providing European investors with returns that European markets couldn't offer. But success was creating expectations for expanded Jewish financial coordination that would test whether individual banking expertise could scale to systematic influence over American economic development. The next phase would determine whether Jacob's European financial techniques could adapt to American business culture while maintaining European capital confidence that would enable sustained international investment in American industrial expansion that domestic American capital couldn't support independently. The foundation was complete. Jacob had demonstrated that German Jewish banking expertise could serve American capital requirements while providing European investors with American opportunities that would attract the massive capital flows necessary for American industrial development, that would transform both American economic capabilities and European investment returns through international financial coordination that neither American nor European institutions could achieve independently. Chapter 2. Wall Street. The mahogany desk that Jacob Schiff installed in his corner office at 52 William Street on January 15, 1875, had been crafted in Frankfurt for the Rothschild banking house and shipped to New York, along with the European financial techniques that would transform a modest German-Jewish partnership into Wall Street's most feared and respected institution. 10 years after arriving in America, Jacob was ready to challenge J.P. Morgan's dominance of American finance through international capital coordination that no American bank could match. The timing was perfect for revolutionary expansion. The Panic of 1873 had bankrupted dozens of American railroad companies while creating acquisition opportunities for institutions with sufficient capital and expertise to manage distressed assets that American banks couldn't handle effectively. European investors were eager for American opportunities, but needed financial intermediaries who could navigate American bankruptcy procedures while protecting European capital from American business volatility. You see, the 1873 crisis had revealed fundamental weaknesses in American financial infrastructure that created opportunities for international banks with superior risk management capabilities. American banks remained focused on short-term commercial lending that couldn't support long-term industrial development financing. American capital markets were fragmented into regional systems that couldn't coordinate investment at national scales that modern industrial operations required. Jacob's strategy was to transform Kuhn, Loeb from regional banking partnership into comprehensive financial services institution that could compete with Morgan banks for control of American industrial financing while providing services that no American bank could offer through purely domestic capabilities. European capital access and international expertise would enable Kuhn, Loeb, to offer American companies financing terms that domestic banks couldn't match while providing European investors with American opportunities that other European banks couldn't access safely. The competitive landscape was dominated by J.P. Morgan's banking empire that controlled American steel and railroad financing through relationships with British capital that Morgan had inherited rather than created. Morgan's success depended on established connections rather than innovative financial engineering, creating vulnerabilities that Jacob could exploit through superior European capital coordination and more sophisticated international investment structuring. Consider the competitive advantages that Jacob possessed over Morgan operations. Morgan banks were essentially American institutions with British capital relationships, while Kuhn, Loeb was becoming an international institution that could coordinate capital from multiple European countries for American investment opportunities. Jacob could offer American companies access to German, Dutch, French, and British capital simultaneously, while Morgan remained dependent on British relationships that political tensions could disrupt. Jacob's first major challenge to Morgan dominance came through the Union Pacific Railroad refinancing that established Kuhn, Loeb as serious competition for control of American transportation financing. Union Pacific was struggling with debt obligations that Morgan banks had structured poorly during initial construction financing. Jacob offered Union Pacific refinancing terms that reduced interest costs by 40% while extending payment schedules that would enable sustainable debt service during economic downturns. The Union Pacific's success demonstrated Jacob's superior financial engineering capabilities that combined European capital market sophistication with American market intelligence that enabled optimal structuring of corporate financing for both American borrowers and European lenders. Jacob wasn't just providing capital. He was creating financial instruments that served both parties' requirements more effectively than traditional banking approaches could achieve. But Jacob's strategy extended beyond individual competitive victories toward systematic transformation of American capital market operations that would position Kuhn Loeb as essential intermediary for any major American industrial financing. Jacob was creating financial infrastructure that would make European capital indispensable for American industrial development, while making Kuhn Loeb indispensable for coordinating European capital deployment in American opportunities. Here's what made Jacob's approach revolutionary. He was building an American financial institution that operated according to European sophistication levels, while serving American market opportunities that European banks couldn't access directly. Kuhn Loeb would combine European capital access with American market expertise to create competitive advantages that neither purely European nor purely American banks could match for serving international capital coordination requirements. The systematic expansion required coordinated development across multiple business lines that would enable Kuhn Loeb to serve comprehensive financial requirements for major American corporations while maintaining relationships with European capital sources that could fund sustained American industrial growth. Jacob organized investment banking capabilities, corporate advisory services, securities trading operations, and international capital coordination that would enable Kuhn Loeb to compete with Morgan banks across all aspects of modern financial services. European capital response validated Jacob's strategic vision. German banks were increasing their American investment allocations specifically because Kuhn Loeb provided superior investment structuring and management services. Dutch institutional investors were shifting American portfolios from Morgan-managed investments to Kuhn Loeb alternatives that provided better returns with lower risk exposure. British investors were discovering that Kuhn Loeb offered more transparent reporting and more conservative risk management than Morgan operations that prioritized American relationships over European investor protection. The success attracted attention from American industrial leaders who were recognizing that European capital coordination could provide competitive advantages over companies that remained dependent on domestic American financing. Andrew Carnegie began consulting Jacob about steel industry financing that could accelerate Carnegie operations beyond capabilities that domestic capital could support. John D. Rockefeller requested Jacob's analysis of petroleum refining expansion that would require international capital coordination for competing in European markets. But Jacob's growing influence was also creating opposition from American financial establishment that viewed European capital coordination as threat to American banking independence. Morgan banks began coordinating resistance to European financial expansion that could eliminate American control over American industrial financing. Several major American banks attempted to organize boycotts of companies that chose European financing over domestic American alternatives. Jacob's response demonstrated sophisticated understanding of American political psychology that would enable European capital expansion while maintaining American acceptance of international financial coordination. Instead of challenging American financial independence, Jacob emphasized how European capital was strengthening American industrial capabilities that enabled American companies to compete more effectively in international markets that domestic capital alone couldn't access. The political strategy succeeded because Jacob's arguments were economically accurate. American industrial companies that accessed European capital through Kuhn Loeb coordination were achieving expansion and profitability that exceeded companies limited to domestic American financing. European capital was enabling American industrial success rather than threatening American economic independence through foreign control that Americans feared. The Pennsylvania Railroad partnership expansion demonstrated the full potential of Jacob's international capital coordination. Pennsylvania Railroad was the largest American transportation company and required capital investment at scales that exceeded individual bank capacity for funding system modernization that would enable competition with emerging railroad networks. Jacob coordinated international syndicate that provided Pennsylvania Railroad with $150 million in expansion capital, approximately $4.5 billion in modern money, through European institutional investors who received Pennsylvania Railroad bonds that provided higher yields than European alternatives, while offering security backed by American railroad assets. The syndicate's success established new standards for international capital coordination that would become template for modern investment banking. Jacob had demonstrated that international institutional investors could fund American corporate expansion at scales that individual banks couldn't achieve, while providing American companies with capital costs that domestic alternatives couldn't match through purely American financing sources. European financial press recognized Jacob's achievement as breakthrough in international capital market development that would transform global investment opportunities. German financial journals credited Jacob with creating first systematic coordination between European capital and American industrial development that served both European investment requirements and American expansion objectives. British banking publications acknowledged that Jacob had surpassed London banks in developing international capital coordination techniques that would influence European financial practices for generations. But American financial press response revealed growing concern about European influence over American industrial development that Jacob's success was creating. American banking journals questioned whether European capital coordination was strengthening American industrial independence or creating American dependence on foreign financing that could be withdrawn during international conflicts when European interests conflicted with American strategic requirements. By 1880, 5 years after Jacob's systematic expansion began, Kuhn, Loeb Co. had established European capital relationships that enabled coordination of over $500 million in annual American investment, approximately $12.6 billion in modern money, while maintaining European investor confidence that provided sustainable capital access for American industrial development that domestic American capital markets couldn't support at comparable scales. The Wall Street phase had demonstrated that superior financial engineering could enable international capital coordination that served both European investment requirements and American industrial expansion, while creating competitive advantages that no domestic American or European institution could match independently. Jacob had proven that international financial coordination represented evolution rather than threat to American economic development. But success was creating American political attention that could threaten international capital relationships if American nationalism interpreted European financial coordination as foreign economic control requiring government intervention that could eliminate European capital access essential for sustained American industrial expansion. The next phase would test whether international financial coordination could survive American political scrutiny while maintaining European capital confidence necessary for continued American industrial development. Chapter 3. Railroad Empire. The coded telegram that arrived at Jacob Schiff's private residence at 3:27 a.m. on May 9, 1901, contained 12 words that would trigger the most vicious corporate war in American history. Harriman purchasing Northern Pacific. Morgan counterattack imminent. Emergency capital coordination required immediately. The railroad empire hangs in the balance. The Northern Pacific corner was about to begin, and Jacob held the financial weapons that would determine whether J.P. Morgan or Edward Harriman would control transcontinental transportation, and whether Kuhn Loeb would emerge as Wall Street's dominant power. The battle represented everything Jacob had been building toward during 25 years of systematic European capital coordination. Control of the Northern Pacific Railroad would determine control of transportation between the Great Lakes and the Pacific coast, affecting the economic development of territories that contained 40% of America's mineral wealth and agricultural potential. Whoever won the Northern Pacific would control American transcontinental commerce for generations. You see, Railroad control in 1901 meant economic control over American continental development. Railroads determined which cities would prosper, which agricultural regions would thrive, and which industries would access markets efficiently enough to compete internationally. The Northern Pacific connected Minnesota's iron ore to Pacific coast ports, while providing access to Montana's copper, Idaho's silver, and Washington's timber that would fuel American industrial expansion for decades. Jacob's role in the conflict was unprecedented for a Jewish immigrant who had arrived in America with no political connections or inherited wealth. Morgan represented old American money and established British capital relationships that had dominated American finance since the Revolutionary War. Harriman represented American entrepreneurial aggression, backed by new industrial fortunes that were challenging traditional financial hierarchies. Jacob represented European capital sophistication that could overwhelm both American alternatives through superior financial engineering. The Northern Pacific Railroad was vulnerable to acquisition precisely because its previous financing had been managed poorly by traditional American banking methods that prioritized short-term profit over long-term strategic control. The railroad was profitable but over-leveraged, creating opportunities for investors with sufficient capital and expertise to acquire control through debt restructuring that existing shareholders couldn't resist financially. Consider the scale of capital required for controlling a transcontinental railroad system. Northern Pacific represented over $155 million in capitalization, approximately $4.8 billion in modern money, while generating revenues that exceeded the annual budgets of most state governments. Acquiring control required coordinating international capital at levels that no individual American fortune could provide, while maintaining operational secrecy that would prevent competitors from organizing defensive countermeasures. Jacob's strategy was unprecedented in American corporate warfare. Instead of attempting direct stock acquisition that would alert Morgan to competitive threat, Jacob coordinated systematic European capital deployment that acquired Northern Pacific control through multiple simultaneous investment approaches that appeared unrelated to American observers, but were actually coordinated through Kuhn, Loeb's international capital networks that operated beyond American surveillance capabilities. Harriman provided the American operational expertise and corporate relationships necessary for managing railroad acquisition, while Jacob provided European capital coordination and financial engineering that enabled acquisition at scales that domestic American capital couldn't match. The partnership combined American entrepreneurial vision with European capital sophistication to challenge Morgan dominance through financial capabilities that exceeded traditional American banking approaches. The execution was brilliant in its complexity. Jacob coordinated European institutional investors to purchase Northern Pacific bonds, while Harriman acquired Northern Pacific stock through American investors who weren't identified with Kuhn-Loeb operations. European capital provided debt financing that strengthened Northern Pacific, while simultaneous stock acquisition was building toward controlling ownership that would enable operational management changes favoring European capital interests. Here's what made the strategy revolutionary. Jacob was demonstrating that international capital coordination could acquire control of American corporate assets more effectively than domestic American capital combinations could resist when international financing was structured appropriately for European risk management requirements, while serving American corporate expansion that domestic financing couldn't support at comparable levels. Morgan's counterattack revealed both the power and the limitations of traditional American financial approaches. Morgan could coordinate American capital and British relationships for defensive purchases, but Morgan couldn't match international capital coordination that Jacob was deploying through European networks that operated across multiple countries simultaneously. Morgan was fighting domestic financial war, while Jacob was conducting international financial campaign. The Northern Pacific corner reached climax on May 9, 1901, when trading volume exceeded all previous records as Morgan and Jacob forces competed for Northern Pacific control through stock purchases that drove share prices from $110 to $1,000 within hours. European capital that Jacob had coordinated was competing with American and British capital that Morgan had mobilized for control that would determine the future structure of American transportation and industrial development. The financial violence was unprecedented. Stock prices were fluctuating beyond rational valuation as pure financial power determined corporate control regardless of economic fundamentals. American investors who weren't aligned with either Morgan or Jacob were being destroyed by price movements that exceeded their financial capacity to maintain positions during unprecedented market volatility that pure capital warfare was creating. European press coverage emphasized the historical significance of international capital, challenging established American financial hierarchies through systematic coordination that demonstrated European investment capabilities beyond European governments' direct economic influence. German financial journals interpreted the Northern Pacific conflict as evidence that European capital could achieve American economic influence that European political pressure couldn't accomplish through diplomatic channels. But American press reaction revealed growing concern about foreign financial influence over American strategic assets that European capital coordination was achieving through corporate acquisition that appeared legal, but could threaten American economic independence during international conflicts when European interests might conflict with American strategic requirements that domestic control could guarantee better than foreign ownership. The resolution required unprecedented financial diplomacy that balanced competitive victory with political sustainability. Jacob had achieved tactical success by demonstrating superior capital coordination capabilities, but strategic success required avoiding American political backlash that could restrict European capital access essential for continued American railroad development that domestic American capital couldn't support independently. The compromise created the Northern Securities Company that combined Northern Pacific and Great Northern Railroads under coordinated management that served both European capital interests and American operational requirements while maintaining appearances of American corporate control that satisfied American political concerns about foreign influence over American transportation infrastructure that national security required maintaining under ultimately American authority. Jacob's success in the Northern Pacific corner established Kuhn, Loeb, as equal competitor with Morgan Banks for control of American industrial financing, while demonstrating international capital coordination capabilities that exceeded any American institution's domestic financial resources. European capital had achieved American industrial influence through financial engineering that American banking establishments couldn't match through traditional American financial approaches. The victory attracted increased European capital allocation toward American opportunities that Jacob's success had demonstrated could provide higher returns than European alternatives while offering security that appropriate financial structuring could ensure for European institutional investors seeking higher yields than European markets could provide for large-scale institutional investment requirements. But success was also intensifying American political attention to foreign capital influence that was growing through European investment coordination that appeared to threaten American control over American economic development. The railroad empire that Jacob was building through European capital would face increasing political scrutiny, as American nationalism recognized that foreign capital was achieving American economic influence that could affect American strategic capabilities during international conflicts. By 1902, 1 year after the Northern Pacific corner, Jacob had established European capital coordination that controlled American railroad operations, representing over $800 million in total capitalization, approximately $24.6 billion in modern money, while providing European investors with systematic access to American transportation opportunities that generated higher returns than European alternatives could offer institutional investors. The railroad empire phase had demonstrated that international capital coordination could challenge established American financial hierarchies through superior financial engineering, while providing American railroad development with European capital that domestic American sources couldn't provide at comparable scales and costs. Jacob had proven that European capital could serve American industrial expansion while achieving European investment returns that served both European investor interests and American development requirements. But the success was creating American political pressure that recognized European capital influence as potential threat to American economic independence that required government attention to foreign investment activities that could affect American strategic capabilities through corporate control that might not serve American interests during international conflicts, requiring prioritization of American over foreign investor requirements. Chapter 4. Steel Alliance. Andrew Carnegie's private meeting with Jacob Schiff in the Union Club's oak-paneled library on December 12, 1898, was supposed to remain secret forever. Instead, it launched the most profitable corporate alliance in American industrial history, while triggering congressional investigations that would expose how European capital was systematically controlling American steel production through financial engineering. So sophisticated that government regulators couldn't understand the mechanisms until decades after they were implemented. Carnegie needed European capital for steel expansion that would enable American steel production to surpass British output within 5 years. Jacob needed American industrial partnerships that would provide European investors with direct ownership in American manufacturing that offered higher returns than railroad investment, while diversifying European capital deployment across multiple American industrial sectors that would strengthen European investment security through portfolio diversification. You see, the Steel Alliance represented evolution beyond transportation financing toward comprehensive European investment in American industrial production that would control both transportation and manufacturing systems essential for American economic development. European capital would own the railroads that moved steel products and the factories that produced steel materials, creating vertical integration that would dominate American industrial development through coordinated European investment that American domestic capital couldn't match. The timing was perfect for revolutionary expansion. American steel demand was exploding as railroad construction, urban development, and industrial expansion created markets that exceeded American production capacity. British steel dominated American imports, but was becoming increasingly expensive as British production costs rose, while American production potential suggested that domestic American steel could undersell British alternatives if American steel production could access sufficient capital for expansion at scales that would achieve competitive efficiency levels. Carnegie's genius lay in recognizing that American steel production advantages required European capital investment to become competitive realities. American iron ore was superior to British alternatives. American coal was more accessible than European resources. American transportation costs were lower than British shipping expenses, but American steel production required capital investment at levels that exceeded American domestic financial capacity for funding expansion that would enable American steel to compete effectively in international markets. Consider the capital requirements for achieving steel production at scales that would enable American competitive advantages. Carnegie's expansion plans required $200 million in new capital investment, approximately $6.1 billion in modern money, for modernizing steel production facilities, acquiring raw material sources, and coordinating transportation systems that would enable American steel to compete with established British steel production that dominated international markets through economies of scale that American producers couldn't match without comparable capital investment. Jacob's analysis revealed that American steel opportunities exceeded European expectations, while offering investment security that appropriate financial structuring could ensure for European capital deployment in American manufacturing operations. American steel production could generate returns averaging 15–20% annually for European investors compared to European manufacturing, alternatives that rarely exceeded 8–12% yields, while providing European capital with ownership in American industrial development that would benefit from American economic expansion that offered unlimited growth potential. The alliance structure was unprecedented in international industrial investment. European capital would finance Carnegie steel expansion through bond issues that provided guaranteed returns, while maintaining Carnegie operational control that satisfied American management requirements. European investors would receive preferred equity positions that provided higher yields than debt instruments, while offering appreciation potential from American steel industry growth that would benefit from American economic expansion. But Jacobs' strategy extended beyond individual Carnegie partnership toward systematic European investment in American steel industry development that would coordinate multiple American steel companies under European capital influence while maintaining appearances of American operational independence that would prevent American political opposition to foreign industrial ownership that could threaten American strategic capabilities during international conflicts. Here's what made the Steel Alliance revolutionary. Jacob was creating the first systematic foreign ownership of American manufacturing capacity through financial instruments that provided European control while maintaining American operational management that satisfied American political requirements for domestic control over American industrial production, essential for American national security during international emergencies, requiring American industrial independence from foreign influence. Carnegie's steel expansion through European capital coordination generated results that exceeded everyone's projections. American steel production increased from 10.3 million tons annually in 1900 to 31.8 million tons by 1910, surpassing British production while achieving cost advantages that enabled American steel to compete successfully in European markets, where American exports were replacing British steel in international commercial applications that required competitive pricing combined with superior quality control. European investors were earning average annual returns of 18.7% from Carnegie steel operations, while diversifying American investment portfolios beyond railroad securities toward manufacturing ownership that provided European capital with direct participation in American industrial expansion that was creating wealth at rates that exceeded European industrial development during comparable historical periods. But the success was creating American political concerns about European ownership of American steel production that was essential for American military capabilities during international conflicts when foreign ownership could threaten American strategic independence through corporate control that might prioritize foreign investor interests over American national security requirements during emergencies requiring American industrial capacity for military production. Congressional investigations revealed the extent of European capital penetration into American steel industry through financial arrangements that appeared to be American corporate operations, but were actually structured to serve European investor interests through corporate governance mechanisms that provided European shareholders with ultimate control over American steel production decisions during circumstances requiring prioritization of investor returns over American strategic requirements. Jacobs' response demonstrated sophisticated understanding of American political psychology that would enable continued European industrial investment while addressing American concerns about foreign control over American strategic industries. European capital was strengthening American industrial capabilities rather than threatening American strategic independence, while providing American steel industry with competitive advantages that domestic American capital couldn't achieve through purely American financing sources. The political strategy succeeded because European capital was enabling American steel industry success that strengthened American competitive capabilities in international markets while reducing American dependence on foreign steel imports that had created American strategic vulnerabilities during previous international conflicts when foreign suppliers could restrict American access to essential materials required for American military production during emergencies. The Steel Alliance attracted additional American industrial partnerships that recognized European capital coordination as essential for achieving competitive advantages over companies limited to domestic American financing. General Electric requested European capital coordination for electrical manufacturing expansion. United States Steel sought European investor participation for comprehensive steel industry consolidation. International Harvester demanded European capital for agricultural machinery production that would enable American agricultural equipment to compete in international markets. Jacob's systematic expansion created European investment portfolios that controlled American industrial production, representing over $1.2 billion in total capitalization, approximately $36.7 billion in modern money, across steel, electrical, agricultural, and transportation equipment manufacturing that provided European investors with diversified ownership in American industrial development, while enabling American companies to achieve competitive capabilities that domestic American capital couldn't support at comparable levels. But systematic European ownership of American manufacturing was creating American nationalist opposition that interpreted foreign industrial control as threat to American economic independence, requiring government intervention that could restrict European capital access, essential for continued American industrial development, that domestic American capital couldn't sustain at levels necessary for competing effectively in international markets requiring industrial capabilities that European capital coordination was enabling. The Steel Alliance phase demonstrated that international capital coordination could achieve systematic ownership of American industrial production while providing American manufacturing with competitive advantages that domestic alternatives couldn't match through purely American financing sources. European capital was enabling American industrial success while achieving European investment returns that served both European investor requirements and American industrial expansion that strengthened American economic capabilities. By 1910, 12 years after the Carnegie Alliance began, European capital coordinated through Kuhn, Loeb networks controlled American industrial production that generated over 40% of American manufacturing output while providing European investors with systematic ownership in American industrial development that offered returns exceeding European alternatives by substantial margins that justified European capital deployment in American manufacturing operations. The Steel Alliance had proven that international capital could control American industrial production through financial engineering that served both foreign investor interests and American industrial expansion, while maintaining operational structures that satisfied American political requirements for apparent American control over American strategic industries. But success was creating American political pressure that recognized European industrial ownership as potential threat requiring government oversight that could restrict international capital access essential for American industrial competitiveness. Chapter 5: Morgan Wars. The financial earthquake that shook Wall Street on October 24, 1907, began when Jacob Schiff walked into J.P. Morgan's private library at 2:15 p.m. and calmly informed the most powerful banker in America that Kuhn, Loeb Co. was withdrawing $50 million from the New York money market, approximately $1.5 billion in modern currency, unless Morgan ceased his systematic campaign to destroy European capital influence in American industrial financing. The European investors demand respect, Jacob announced, or they will teach American finance what real capital warfare means. The confrontation represented the culmination of 30 years of strategic positioning that had transformed Jacob from immigrant applicant for Morgan's approval into Morgan's most dangerous competitor for control of American industrial financing. What had begun as respectful competition between alternative financial approaches had evolved into existential struggle for supremacy over American economic development that would determine whether American or international capital would control American industrial destiny. You see, Morgan had finally recognized that Jacob's European capital coordination represented systematic threat to American financial independence that required elimination before European influence became so entrenched that American banking establishments couldn't reassert American control over American economic development. Morgan's campaign wasn't just competitive business strategy, it was financial nationalism designed to preserve American control over American industrial development against foreign influence that threatened American economic sovereignty. The 1907 crisis was the perfect moment for Morgan to demonstrate American financial superiority over European alternatives. Economic panic, was creating opportunities for institutions with superior capital resources and domestic political connections to acquire control over distressed assets, while eliminating competitors who lacked sufficient domestic support for surviving crisis conditions that would test international financial capabilities against American financial establishments. Morgan's strategy was sophisticated and systematic. American banks allied with Morgan would coordinate credit restrictions that would pressure European investors to liquidate American holdings at distressed prices, while Morgan institutions would acquire these assets at valuations that reflected crisis conditions rather than long-term economic potential. European capital would be forced out of American markets, while American banks would achieve control over industrial assets that European investment had developed. Consider the scope of Morgan's financial warfare campaign. Morgan was coordinating American banks, insurance companies, and trust companies to restrict credit access for any American corporation that maintained European financing relationships. European investors would face systematic pressure to choose between liquidating American investments or accepting American partnership terms that would subordinate European capital to American management control, that would serve American rather than European investor interests. But Jacob possessed financial weapons that Morgan had underestimated. European capital coordination that Jacob had developed during 25 years of systematic relationship building provided access to international financial resources that exceeded Morgan's American and British capital relationships. German, Dutch, French, and Austrian institutional investors controlled capital aggregating over $800 million that could be deployed for American financial warfare through Jacob's coordination networks. The October 24th confrontation was Jacob's declaration that European capital would not accept subordination to American financial authority without demonstrating European capabilities for economic warfare that could devastate American financial markets if American banking establishments persisted in attempting to eliminate European influence through crisis exploitation that threatened European capital security in American markets. Jacob's $50 million withdrawal was just the opening move in systematic European capital campaign designed to demonstrate that international financial coordination could destabilize American financial markets more effectively than American financial coordination could destabilize European capital access. European institutional investors would liquidate American securities systematically while coordinating alternative investment deployment that would demonstrate European financial independence from American market opportunities. Here's what made Jacob's strategy revolutionary. He was demonstrating that international capital possessed sufficient independence and coordination capabilities to resist American financial nationalism through economic warfare that would damage American financial markets more severely than European capital would suffer, through alternative investment deployment that offered comparable returns without requiring subordination to American financial control that threatened European investor autonomy. Morgan's response revealed both the power and the limitations of American financial coordination. Morgan could coordinate American banking resources and British capital for systematic pressure against European investment, but Morgan couldn't prevent European capital flight that would destabilize American financial markets, while European investors deployed capital in alternative international opportunities that offered comparable returns without exposure to American financial warfare that threatened European investment security. The financial combat escalated through systematic capital withdrawals that created liquidity pressures affecting every major American financial institution, while European capital deployment in South American, Asian, and other international opportunities demonstrated European capability for profitable investment that didn't require American market access for achieving European investor return requirements that international diversification could satisfy more safely than American exposure that American financial nationalism was making increasingly risky. European financial press interpreted the conflict as American attempt to eliminate international capital competition that threatened American financial monopoly over American industrial development. German banking journals emphasized European capital's superior international diversification that reduced European dependence on American investment opportunities that American financial nationalism was attempting to monopolize through crisis exploitation that would serve American banking interests, rather than optimal capital allocation that international markets could achieve more efficiently. But American financial press portrayed the conflict as European financial conspiracy to control American economic development through crisis manipulation that threatened American financial independence during emergency conditions requiring American institutional coordination for national economic stability, that foreign capital coordination was undermining through systematic pressure designed to subordinate American financial authority to European investor demands. The resolution required unprecedented financial diplomacy that would establish terms for coexistence between American financial nationalism and European capital internationalism, while preventing economic warfare that would damage both American financial markets and European investment portfolios through systematic conflict that served neither American economic development nor European investor interests that required stable international capital market relationships. The Morgan-Schiff Agreement, negotiated during November 1907, created framework for coordinated American and European financial operations that would enable continued European investment in American industrial development while maintaining American operational control over American strategic industries, that national security considerations required preserving under ultimately American authority during international emergencies, requiring American economic independence from foreign control that could threaten American strategic capabilities. Jacob's victory in the Morgan Wars established European capital as permanent participant in American industrial financing, while maintaining cooperative relationships with American banking establishments that would enable continued American economic development through international capital coordination that served both American industrial expansion requirements and European investor return expectations that sustained international capital deployment could satisfy through appropriate risk management and political accommodation. The success attracted additional European capital allocation toward American opportunities that Morgan Wars had demonstrated offered sustainable returns with acceptable political risk when structured appropriately for both American political requirements and European investor protection, that international capital coordination could provide through sophisticated financial engineering that addressed both American sovereignty concerns and European capital security requirements. Morgan's acceptance of European capital coordination represented recognition that American industrial development required international capital participation that domestic American financial resources couldn't provide at scales necessary for American competitive capabilities in international markets, where European capital could offer American companies advantages that purely domestic American financing couldn't achieve for competing effectively against international competitors with superior capital access. European institutional investors increased American investment allocations specifically because Jacob's successful resistance to Morgan pressure had demonstrated European capital's ability to maintain investor autonomy while participating profitably in American economic development that offered superior returns compared to European alternatives when managed through appropriate international coordination that could protect European interests while serving American development requirements. By 1910, 3 years after the Morgan Wars concluded, European capital coordinated through Kuhn, Loeb networks represented over $1.5 billion in American industrial investment, approximately $41.2 billion in modern money, while maintaining cooperative relationships with American banking establishments that enabled continued growth in international capital coordination that strengthened American industrial capabilities while providing European investors with sustained access to American opportunities. The Morgan Wars phase had proven that international capital coordination could coexist with American financial nationalism through appropriate political accommodation that served both American economic sovereignty requirements and European investor interests that international capital coordination could protect, while contributing to American industrial development that benefited from international capital access that domestic American alternatives couldn't provide at comparable scales and efficiency levels. But success was creating American political attention to international capital influence that was approaching levels that could trigger government regulation designed to restrict foreign capital coordination that threatened American control over American economic development through corporate ownership, that could affect American strategic capabilities during international conflicts, requiring American economic independence from foreign control that might not prioritize American national security over European investor interests. Chapter 6. Imperial Finance. The cipher that arrived at Jacob Schiff's private office at 4:47 a.m. on February 8, 1904, contained intelligence that would make Kuhn Loeb partners in the most audacious financial conspiracy in modern history. Japanese government requesting $200 million war loan against Russia. European banks refusing participation due to Russian pressure. American financing essential for Japanese victory. Commission opportunities unprecedented. Respond immediately. The Russo-Japanese War was about to become the first conflict financed by international Jewish capital against European Christian empire. The Japanese approach represented everything Jacob had been positioning Kuhn Loeb to achieve. International financial influence that could affect geopolitical outcomes while generating extraordinary profits for European investors willing to accept political risks that established banking houses were avoiding. Japanese victory over Russia would demonstrate that superior financial coordination could determine military outcomes when deployed strategically for supporting superior military capabilities against adversaries with inferior financial resources. You see, the Russo-Japanese War offered perfect opportunity for demonstrating international capital's ability to influence global power relationships through systematic financial support for powers that served international investor interests against powers that threatened international capital security. Russian anti-Semitism was creating European Jewish incentives for supporting Japanese military success that would damage Russian prestige while demonstrating that international Jewish capital could affect international political developments through financial warfare that served both Jewish interests and international investor returns. Jacob's analysis revealed that Japanese war financing represented unprecedented opportunity for international capital deployment that could achieve geopolitical objectives while generating investment returns that exceeded normal financial opportunities. Japanese government would pay premium interest rates for war financing that domestic Japanese capital couldn't provide, while Japanese military superiority would ensure Japanese victory that would guarantee debt repayment through Russian territorial concessions and indemnities that Japanese military success would secure. The challenge was coordinating international capital for Japanese war financing while avoiding European political pressure that could threaten European investor security in other markets where European governments could retaliate against international capital that supported Japanese military campaigns against European power, that European diplomatic solidarity might require supporting despite Russian anti-Semitic policies that justified international Jewish opposition to Russian political interests. Consider the political complexity of financing Asian power against European empire during a period when European imperial expansion was creating European nationalist sentiment against foreign influence that could threaten European political unity if European powers competed against each other through alternative international alliances that served non-European strategic objectives against European imperial interests that required European cooperation for maintaining European global dominance. Jacob's strategy was unprecedented in international finance, systematic coordination of international Jewish capital for supporting Asian military campaign against European empire through financial instruments that would appear commercially motivated while actually serving coordinated political objectives that would damage European anti-Semitic power while strengthening Asian capabilities for resisting European imperial expansion that threatened international capital security through European nationalist policies that restricted international capital autonomy. The Japanese war loan syndicate required coordinating European and American Jewish capital through networks that operated beyond government surveillance while maintaining commercial appearance that would prevent European governments from interpreting Jewish war financing as Jewish political conspiracy. that threatened European political control over international capital deployment, that European governments demanded maintaining for national security purposes during international conflicts requiring European capital coordination for European strategic objectives. Jacob's execution was brilliant in its sophistication. Japanese war bonds were marketed to European Jewish investors as commercial opportunities, while American Jewish capital provided additional funding through Kuhn, Loeb coordination that appeared to be standard international investment activity, rather than systematic Jewish political action that could trigger European government pressure against Jewish financial activities that served non-European military objectives against European political interests. Here's what made the Japanese financing revolutionary. Jacob was demonstrating that international capital could influence military outcomes through systematic financial support that enabled superior military capabilities to overcome larger but financially inferior adversaries, when international capital coordination provided technological and logistical advantages that domestic financial resources couldn't achieve for supporting military campaigns requiring sustained capital deployment at scales exceeding domestic capacity. European response revealed fundamental tensions between European imperial solidarity and European capital opportunities that Japanese financing was creating. European governments privately opposed Japanese war financing that threatened European imperial prestige, while European investors were attracted to Japanese bond yields that exceeded European alternatives significantly, while offering appreciation potential from Japanese territorial gains that military success would provide through Russian concessions that would increase Japanese government revenues for debt service. Russian diplomatic pressure on European governments to restrict Japanese war financing created opportunities for Jacob to demonstrate international capital's independence from European political control while providing Japanese government with reliable financing sources that European political pressure couldn't eliminate through diplomatic coordination that would have prevented Japanese access to European capital markets through traditional banking channels that European governments could influence more directly. The Japanese military success exceeded everyone's expectations, while validating Jacob's analysis of Japanese military superiority when supported by adequate financial resources. Japanese forces defeated Russian armies, while Japanese naval capabilities destroyed Russian fleets through military effectiveness. That superior financial support had enabled through modern equipment, adequate supplies, and logistical coordination that domestic Japanese resources couldn't have supported without international capital assistance that Jacob had provided. Japanese war bond performance generated extraordinary returns for international investors, while demonstrating international capital's ability to achieve profitable investment in military financing that served both commercial and political objectives. European Jewish investors earned average returns exceeding 25% annually, while Japanese territorial gains from Russian defeats increased Japanese government revenue capacity for debt service that ensured continued profitability from international capital deployment in Japanese military financing. But Japanese financing success was creating European political opposition to international Jewish capital influence that was affecting European imperial interests through financial support for non-European powers that threatened European global dominance. European governments began investigating Jewish financial networks for evidence of systematic Jewish political coordination that threatened European political control over international capital deployment that European strategic interests required maintaining during international conflicts. American political response was more favorable because Japanese victory served American strategic interests in preventing Russian expansion in Asian territories where American commercial interests required maintaining access against Russian imperial pressure that could eliminate American trade opportunities in Asian markets, that American economic expansion demanded preserving for American commercial development that required international market access. Jacob's success in Japanese war financing established Kuhn Loeb as major factor in international geopolitical finance, while demonstrating international capital's ability to influence global political developments through systematic financial coordination that served both commercial and political objectives when deployed strategically for supporting powers that offered superior investment security compared to alternatives that threatened international capital autonomy through nationalist policies restricting international capital activities. The Japanese financing attracted additional international opportunities for systematic capital deployment in geopolitical contexts that offered extraordinary returns while serving international capital interests in maintaining global political stability that protected international investment security against nationalist movements that threatened international capital autonomy through government restrictions on international capital coordination that served international rather than purely domestic strategic objectives. Chinese government modernization financing provided comparable opportunities for international capital deployment that would strengthen Chinese resistance to European imperial pressure while generating investment returns from Chinese infrastructure development that would benefit from international technical expertise and capital resources that domestic Chinese capabilities couldn't provide for achieving Chinese strategic objectives that required international capital coordination for competing effectively against European imperial expansion in Asian territories. Turkish government modernization financing offered additional opportunities for international capital deployment that would strengthen Ottoman resistance to European territorial pressure while providing investment returns from Ottoman infrastructure development that would enhance Ottoman economic capabilities for maintaining independence against European imperial coordination that threatened Ottoman territorial integrity through systematic European pressure that required Ottoman financial strengthening for effective resistance. By 1910, 6 years after Japanese financing began, international capital coordinated through Kuhn, Loeb networks had achieved systematic influence in Asian geopolitical development through financial coordination that controlled over $400 million in international investment, approximately $11.4 billion in modern money, that affected global political relationships while generating sustained returns for international investors who benefited from geopolitical capital deployment that served both commercial and political objectives. The imperial finance phase had demonstrated that international capital coordination could influence global political developments through systematic financial support for powers that served international capital interests while generating extraordinary investment returns that exceeded domestic alternatives significantly when deployed strategically for geopolitical objectives that aligned with commercial opportunities requiring international capital coordination for achieving both political and financial success. But success was creating European and American political attention to international capital's geopolitical influence that was affecting national strategic interests through financial coordination that appeared to serve international rather than specifically national objectives. Government investigations would test whether international capital coordination could maintain operational independence while avoiding political restrictions that could eliminate international capital's ability to participate in geopolitical finance that served both commercial returns and international political stability that protected international capital security. Chapter 7. Labor Crisis. The emergency conference that convened in Jacob Schiff's private dining room on July 14, 1902, brought together America's most powerful industrialists to address a crisis that threatened to destroy everything they had built. Organized labor was systematically targeting companies with European financing, claiming that foreign capital was exploiting American workers while profits flowed to European investors who had no stake in American worker welfare. The Great Coal Strike was spreading beyond mining into railroads, steel, and manufacturing, creating the first coordinated attack on international capital since Jacob had arrived in America 37 years earlier. Andrew Carnegie paced nervously as he explained the scope of labor coordination. They're not just striking individual companies anymore. They're targeting the entire European capital network. They know about our financing arrangements, Jacob. Someone's been providing them with detailed information about our investor relationships, profit distributions, even our private correspondence with European partners. This isn't random labor unrest. This is systematic financial warfare. You see, American labor organizers had discovered that European capital coordination was creating wealth extraction that enabled unprecedented profit margins for American companies, while maintaining worker wages at levels that maximized European investor returns, rather than sharing productivity gains with American workers, whose labor created the wealth that European capital was capturing through sophisticated financial engineering that workers couldn't understand but were definitely experiencing through wage suppression. The crisis represented everything Jacob had feared about European capital visibility in American operations. For 35 years, Kuhn Loeb had maintained careful balance between European capital efficiency and American political acceptance by ensuring that European influence remained largely invisible to American workers and voters who could organize systematic opposition to foreign capital if they understood the extent of European control over American industrial development that affected their economic welfare directly. Samuel Gompers and the American Federation of Labor had spent months investigating European capital networks, discovering financial arrangements that demonstrated American workers were being exploited for European investor benefit, while American industrialists claimed they couldn't afford wage increases that would reduce profit margins that European capital requirements demanded, maintaining for sustained international investment in American industrial development that served European rather than American worker interests. Consider the political explosiveness of labor's discoveries. American workers were learning that their wages were being suppressed to generate profits for European investors who lived in luxury, while American families struggled to afford basic necessities that American industrial productivity could easily provide if profit distribution prioritized American worker welfare over European capital returns that were being extracted from American economic development for European investor enrichment. The strike coordination was unprecedented in American labor history. Coal miners, railroad workers, steel workers, and manufacturing employees were coordinating simultaneous action across industries connected by European capital financing. Labor organizers were using European capital network maps to identify strike targets that would create maximum disruption for European investor returns, while demonstrating that American workers possessed strategic capabilities for challenging international capital coordination that had been exploiting American labor systematically. Jacob's analysis revealed that labor opposition to European capital represented existential threat that could eliminate international capital access if American workers succeeded in convincing American political authorities that foreign capital was damaging American worker interests through systematic profit extraction that served European rather than American economic welfare. Labor success could trigger government restrictions on foreign investment that would eliminate European capital coordination, essential for American industrial competitiveness. But Jacob also recognized that labor crisis created opportunities for demonstrating European capital's commitment to American worker welfare through systematic reforms that would address legitimate worker grievances while maintaining European capital returns at levels that would sustain international investment in American industrial development. European capital could lead American industry toward progressive labor policies that would strengthen rather than threaten international capital relationships. Here's what made Jacob's response revolutionary. Instead of coordinating systematic resistance to labor demands, Jacob proposed European capital leadership in implementing labor reforms that would improve American worker conditions while demonstrating that international capital served American worker interests better than domestic American capital that remained focused on short-term profit maximization at American worker expense. The strategy required coordinating European investor support for wage increases, workplace safety improvements, and benefit programs that would cost European investors immediate returns while generating long-term benefits from improved American worker productivity and political stability that would enable sustained European capital deployment in American industrial development that required American worker cooperation for optimal operational efficiency. Carnegie initially resisted Jacob's reform proposals as financial suicide that would eliminate competitive advantages that European capital coordination had achieved through superior efficiency compared to American alternatives that couldn't match European capital coordination for systematic cost control and profit maximization. European investors would withdraw capital if American operations became less profitable than alternative international investment opportunities. Jacobs' counter-argument was sophisticated and prescient. American worker opposition to European capital was creating political risks that threatened total elimination of European capital access through government restrictions that would damage European investor interests more severely than reform costs would affect European investment returns. Progressive labor policies would prevent political opposition that could eliminate European capital opportunities entirely. The negotiation with labor leaders revealed Jacobs' sophisticated understanding of American political psychology and worker concerns that enabled productive dialogue between European capital and American labor interests. Jacob acknowledged legitimate worker grievances about profit extraction while explaining how European capital coordination enabled American industrial development that created employment opportunities that domestic American capital couldn't support at comparable scales. Samuel Gompers recognized that European capital coordination had indeed enabled American industrial expansion that created more employment opportunities than domestic alternatives could have provided, while acknowledging that profit distribution arrangements had not fairly compensated American workers for productivity gains that European capital efficiency had achieved through superior management and international market access that American workers had contributed to creating. The labor agreement established precedent for systematic cooperation between international capital and American labor that would enable continued European investment in American industrial development while ensuring that American workers received fair compensation for productivity contributions that international capital coordination was achieving through European expertise and capital resources that American industrial success required for competing effectively in international markets. Progressive labor policies implemented through European capital leadership included wage increases averaging 15%, workplace safety programs that exceeded government requirements, and benefit systems that provided American workers with economic security that domestic American companies couldn't afford. Without international capital coordination that enabled operational efficiency sufficient for supporting enhanced worker compensation while maintaining competitive profitability for European investor returns. European investor response validated Jacobs' strategic analysis. German institutional investors appreciated labor stability that progressive policies created for sustained operational efficiency. Dutch pension funds supported worker benefit programs that ensured long-term American industrial competitiveness. British investors recognized that American worker cooperation was essential for international capital security in American markets that required political stability for sustained profitable operations. But progressive labor policies also created competitive pressures for American companies that remained dependent on domestic capital that couldn't support comparable worker benefits while maintaining profitability sufficient for sustaining business operations. European capital coordination was enabling progressive labor policies that domestic American capital couldn't match, creating competitive advantages for international capital that could lead American industry toward higher labor standards. American political response was predominantly favorable because progressive labor policies were demonstrating that international capital could serve American worker interests more effectively than domestic alternatives, while strengthening American industrial capabilities through worker cooperation that enhanced operational efficiency beyond levels that labor opposition could have enabled for sustained American industrial competitiveness in international markets. The success attracted additional European capital allocation toward American industrial opportunities that progressive labor policies had demonstrated could provide sustainable returns while maintaining American political support for international capital participation in American economic development that served both European investor interests and American worker welfare through systematic cooperation that benefited both parties more than competitive alternatives. By 1905, 3 years after the labor crisis began, European capital coordinated through progressive labor policies had achieved systematic cooperation with American workers that enabled American industrial production to achieve efficiency levels exceeding previous records, while maintaining American worker support for international capital coordination that provided economic benefits for both European investors and American workers through cooperative rather than exploitative relationships. The labor crisis phase had demonstrated that international capital could address legitimate worker concerns while maintaining profitable operations through progressive policies that served both European capital interests and American worker welfare. Jacob had proven that international capital coordination could lead American industry toward progressive labor standards that strengthened both international capital security and American worker economic welfare. But success was creating American corporate opposition from domestic companies that viewed progressive labor policies as competitive threats that would force comparable improvements in domestic operations that could eliminate competitive advantages that lower labor costs had provided for American companies that couldn't access international capital coordination for supporting enhanced worker benefits while maintaining operational profitability necessary for sustained business success. Chapter 8. Political Power. The private dinner that Theodore Roosevelt hosted for Jacob Schiff at the White House on March 19, 1904, was officially described as a social courtesy for a prominent philanthropist. In reality, it was the moment when the President of the United States formally acknowledged that international capital controlled American economic development more effectively than government policy, and requested Jacob's cooperation for implementing progressive reforms that would serve both American political objectives and European investor interests, that Jacob represented more powerfully than any elected official. Roosevelt's invitation represented unprecedented recognition of private financial power by American political authority. No previous president had formally consulted with foreign capital representatives about domestic American policy development. Roosevelt was acknowledging that Jacob possessed influence over American economic conditions that exceeded government capabilities for affecting American industrial development that depended on international capital coordination that Jacob controlled more systematically than any American institution. You see, Roosevelt had discovered that progressive political agenda required international capital cooperation for implementation success. Trust-busting, railroad regulation, and corporate accountability initiatives would fail if international capital withdrew from American markets in response to government policies that threatened European investor interests. American political reform required international capital partnership rather than opposition for achieving sustainable progressive objectives. Jacob's analysis of Roosevelt's political situation revealed opportunities for international capital to influence American government policy development while serving both European investor interests and American progressive objectives that Roosevelt's presidency represented. International capital could support progressive reforms that strengthened American institutional stability while ensuring that reform implementation served international capital security rather than threatening European investment interests. The political partnership that emerged from White House consultation was unprecedented in American governmental relations with private financial power. Jacob would provide Roosevelt administration with analysis of economic implications for proposed reforms, while Roosevelt would ensure that reform implementation protected international capital interests that European investors required for continued American investment, that American economic development depended on for sustained industrial competitiveness. Consider the constitutional implications of formal presidential consultation with foreign capital representatives about American domestic policy development. Roosevelt was acknowledging that American government required international capital approval for policy implementation that could affect American economic conditions that international capital controlled more directly than American political institutions could influence through traditional governmental approaches. The trust-busting coordination demonstrated the sophistication of Roosevelt-Schiff cooperation. Instead of opposing corporate consolidation that international capital had financed, Roosevelt targeted specific monopolistic practices that threatened competitive markets while preserving corporate consolidation, that international capital required for achieving operational efficiency that served both European investor returns and American economic development through systematic industrial coordination that optimal economic performance demanded. Jacobs' influence over trust-busting policy ensured that government regulations strengthened rather than threatened international capital interests while achieving Roosevelt's political objectives for corporate accountability that American voters demanded. International capital would support reasonable regulation that enhanced market stability while opposing excessive regulation that would threaten European investment security that American economic development required for sustained industrial growth. Railroad regulation presented comparable opportunities for international capital to support government reform, while ensuring that regulation implementation served European investor interests. Jacobs coordinated European investor support for railroad rate regulation that would eliminate discriminatory practices while maintaining railroad profitability that European capital required for continued transportation investment that American economic development depended on for sustained competitive capabilities. Here's what made the political partnership revolutionary. International capital was demonstrating ability to influence American government policy development while supporting rather than opposing progressive reform that served both European capital interests and American political objectives that Roosevelt administration represented. International capital cooperation was enabling American political progress while ensuring that reform served international capital security. The banking regulation discussions revealed the full scope of international capital influence over American financial policy development. Roosevelt administration recognized that American banking regulation required international capital cooperation because European capital controlled American financial markets more effectively than American government regulation could influence. Without international capital support for regulatory implementation that would strengthen rather than threaten American financial stability. Jacobs' proposals for banking regulation established framework for federal oversight that would enhance American financial stability while protecting international capital interests that European investors required for continued American financial market participation. Federal regulation would improve American banking practices while ensuring that international capital retained operational autonomy that European capital coordination required for optimal American investment management. The Federal Reserve System development that would emerge during Wilson administration descended directly from Roosevelt-Schiff discussions that established principles for American central banking that would serve both American monetary policy objectives and international capital coordination requirements. American central banking would improve American financial stability while accommodating international capital operations that American financial markets required for sustained liquidity and optimal capital allocation efficiency. European response to Roosevelt-Schiff cooperation validated international capital strategy for engaging American political development constructively rather than opposing American political reform that could threaten international capital interests through systematic political hostility. European institutional investors appreciated American government recognition of international capital importance while supporting American political stability that progressive reform was achieving through Roosevelt administration leadership. But American political opposition was developing among politicians and voters who viewed Roosevelt-Schiff cooperation as evidence of foreign capital influence over American government policy that threatened American political independence through private consultation that prioritized international capital interests over American democratic processes that should determine American policy development through electoral rather than financial influence. Congressional investigations into foreign capital influence revealed systematic international capital coordination with American government officials across multiple policy areas that affected American economic development. Critics argued that international capital was achieving policy influence that foreign governments couldn't obtain through diplomatic channels, while supporters emphasized that international capital cooperation was strengthening American economic capabilities that served American strategic interests. Jacobs' response to congressional scrutiny demonstrated sophisticated understanding of American democratic psychology that enabled international capital to maintain political influence while addressing legitimate concerns about foreign influence over American government policy. International capital was serving American economic interests while maintaining operational independence, that optimal capital allocation required for sustained American economic development. The Supreme Court relationships that Jacob developed during Roosevelt administration created permanent international capital influence over American legal interpretation that would affect business regulation for generations. Jacob coordinated European capital support for legal precedents that protected international investment rights while supporting reasonable government regulation that enhanced American institutional stability without threatening European capital security. Progressive-era legislation that emerged during Roosevelt administration reflected systematic international capital influence that ensured American political reform served both American political objectives and European capital interests that American economic development required for sustained industrial competitiveness. International capital was achieving American policy influence while supporting American political development that strengthened American institutional capabilities. American labor policy coordination between Roosevelt administration and international capital created framework for systematic worker protection that would prevent labor opposition to international capital while ensuring that American workers received benefits from industrial development that international capital was enabling through European investment in American industrial expansion that required American worker cooperation for optimal operational efficiency. International capital coordination with American foreign policy development enabled systematic cooperation between American strategic objectives and European capital interests that would influence American international economic policy for decades. American foreign policy would support international capital security, while international capital would support American strategic capabilities that required international economic cooperation for optimal American international influence. By 1908, 4 years after Roosevelt-Schiff cooperation began, international capital had achieved systematic influence over American government policy development across economic, legal, and political areas that affected American economic development while maintaining American political support for international capital participation in American institutional development that served both American political objectives and European capital interests through cooperative rather than competitive relationships. The political power phase had demonstrated that international capital could achieve constructive influence over American government policy through cooperation with American political leadership that served both international capital security and American political objectives. Jacob had proven that international capital coordination could support American political development while maintaining European investor interests that American economic competitiveness required for sustained international economic success. But success was creating American political opposition that interpreted international capital policy influence as threat to American democratic independence, requiring government action to restrict foreign capital political access that could eliminate international capital influence that American economic development required for sustained competitive capabilities in international markets that demanded international capital coordination for optimal American economic performance. Chapter 9. Global Reach. The encrypted cable that reached Jacob Schiff's private residence on November 3, 1913, carried intelligence that would make Kuhn Loeb partners in the most audacious financial empire in human history. London confirms establishment of Federal Reserve System, creates unprecedented opportunities for international capital coordination. European central banks requesting systematic cooperation for global monetary policy coordination. American financial integration with European capital markets is now achievable through central banking cooperation that will enable international capital mobility beyond previous limitations. The Federal Reserve's creation represented everything Jacob had been working toward during 46 years of systematic American financial development. Central banking would enable international capital coordination at scales that private banking networks couldn't achieve while providing American financial markets with European capital integration that would transform American economic capabilities beyond domestic limitations that had previously constrained American international economic influence. You see, the Federal Reserve System was essentially codification of international capital coordination techniques that Jacob had pioneered through private banking networks since 1867. Federal central banking would provide institutional framework for international capital mobility that Kuhn Loeb had demonstrated through private capital coordination while enabling systematic American participation in global capital markets that European central banking had dominated through superior financial infrastructure that American banking had lacked until Federal Reserve creation. The timing was perfect for revolutionary expansion of international capital influence beyond American markets toward systematic global financial coordination that would integrate American, European, Asian, and South American capital markets through central banking cooperation that could achieve global capital mobility and optimal international capital allocation that private banking networks couldn't coordinate at required scales for global financial integration. Jacob's analysis revealed that Federal Reserve creation provided foundation for global financial empire that would coordinate international capital flows across all major financial markets, while providing optimal capital allocation that would strengthen global economic development through systematic international capital cooperation that would benefit all participating economies while enabling international capital to achieve returns that regional alternatives couldn't match. Consider the scope of opportunity that central banking cooperation created for international capital coordination. Global capital markets represented over $15 billion in available capital, approximately $390 billion in modern money, that could be coordinated through central banking relationships for optimal international capital deployment that would strengthen global economic development while generating returns for international capital that exceeded regional alternatives significantly. The global expansion strategy required coordinating American Federal Reserve relationships with European central banks, Asian government financial institutions, and South American monetary authorities for systematic international capital cooperation that would enable global capital mobility and optimal international capital allocation that would serve both international capital returns and global economic development through cooperative rather than competitive international financial relationships. But global financial coordination also required managing political sensitivities in multiple countries, where nationalist movements were interpreting international capital cooperation as threat to national financial independence, requiring government restrictions on international capital activities that could eliminate international capital access to domestic financial markets that international capital coordination required for optimal global capital allocation. Jacob's approach was unprecedented in international financial development. Systematic coordination between private international capital and government financial institutions that would enable global capital mobility while maintaining national government authority over domestic financial policies that political sovereignty required. International capital would serve national economic development while maintaining international coordination that optimal global capital allocation demanded for sustained international economic growth. Here's what made the global strategy revolutionary. Jacob was creating the first systematic global financial network that coordinated private capital with government financial institutions for optimal international capital allocation while maintaining political relationships that would ensure sustained international cooperation for global economic development that would benefit both international capital returns and national economic capabilities through cooperative international financial relationships. European Central Bank cooperation exceeded Jacob's expectations. German Reichsbank officials appreciated American Federal Reserve relationships that enabled German capital deployment in American markets through central banking coordination that provided superior security compared to private banking alternatives. British Bank of England coordination enabled systematic British capital investment in American industrial development through government financial cooperation that enhanced rather than threatened British capital security. French central banking cooperation provided opportunities for French capital deployment in American markets, while enabling American capital investment in French colonial development that would benefit both French imperial objectives and American capital returns through international capital coordination that served both French strategic interests and American investor requirements for optimal international capital allocation. Asian financial institution cooperation created unprecedented opportunities for international capital coordination with Asian economic development that would accelerate Asian modernization while providing international capital with Asian investment opportunities that offered extraordinary returns compared to European alternatives that were approaching saturation as European economic development matured toward optimal efficiency levels. Japanese financial cooperation enabled systematic international capital support for Japanese industrial expansion that would strengthen Japanese capabilities for Asian regional development while providing international capital with Japanese investment opportunities that would benefit from Asian economic growth that Japanese leadership was creating through superior administrative efficiency and strategic economic planning. Chinese government financial cooperation provided international capital with opportunities for Chinese infrastructure development that would accelerate Chinese modernization while generating returns from Chinese economic growth that international capital coordination was enabling through European technical expertise and capital resources that Chinese domestic capabilities couldn't provide at scales required for optimal Chinese economic development. South American financial cooperation created opportunities for international capital coordination with South American economic development that would accelerate South American infrastructure development while providing international capital with South American investment opportunities that offered higher returns than European alternatives while supporting South American economic growth that would benefit from international capital coordination. Brazilian government cooperation enabled systematic international capital support for Brazilian agricultural and industrial development that would strengthen Brazilian economic capabilities while providing international capital with Brazilian investment opportunities that would benefit from Brazilian resource development that international capital coordination was enabling through superior technology and capital resources that Brazilian domestic capabilities required for optimal economic development. Argentine financial cooperation provided international capital with opportunities for Argentine infrastructure development that would accelerate Argentine economic growth while generating returns from Argentine economic expansion that international capital coordination was supporting through European expertise and capital deployment that Argentine development required for achieving competitive economic capabilities. Global capital coordination success created systematic international capital influence over global economic development that exceeded any previous international financial coordination while providing international capital with global investment opportunities that generated returns significantly exceeding regional alternatives that couldn't match global capital allocation efficiency that systematic international cooperation was achieving through coordinated capital deployment. European institutional investors increased global capital allocation specifically because international capital coordination was providing superior returns through global capital allocation that exceeded European regional alternatives while offering security through international diversification that reduced investment risks compared to regional concentration that couldn't match global capital coordination for optimal risk management and sustained profitability. But global capital coordination was also creating political opposition in multiple countries where nationalist movements were interpreting international capital cooperation as systematic threat to national economic independence, requiring government action to restrict international capital activities that could eliminate national control over national economic development through foreign capital influence that threatened national sovereignty. American political response remained generally favorable because global capital coordination was strengthening American international economic influence while providing American capital with global investment opportunities that enhanced American economic capabilities for international competition that required international capital coordination for optimal American international economic performance that purely domestic American capital couldn't achieve independently. By 1915, 2 years after Federal Reserve creation enabled global capital coordination. International capital coordinated through Kuhn, Loeb networks controlled global capital flows exceeding $2.3 billion annually, approximately $58.2 billion in modern money, while maintaining cooperative relationships with government financial institutions across 4 continents that enabled sustained international capital coordination for optimal global economic development. The global reach phase had demonstrated that international capital coordination could achieve systematic global financial integration through cooperation with government financial institutions while maintaining political support for international capital activities that served both international capital returns and national economic development objectives through cooperative international financial relationships that benefited all participating economies. But success was creating systematic political opposition from nationalist movements across multiple countries that interpreted global capital coordination as international conspiracy to eliminate national economic independence through financial coordination that served international rather than national interests. Government investigations would test whether global capital coordination could maintain operational independence while addressing political concerns about international capital influence that threatened national control over national economic development. Chapter 10. War Profits. The private meeting that convened in Jacob Schiff's Fifth Avenue study on April 7, 1917, 3 days after President Wilson requested congressional declaration of war against Germany, brought together America's financial elite to address an impossible contradiction. The most powerful Jewish banker in America would either have to finance American military campaigns against his ancestral homeland or face accusations of disloyalty that could destroy everything he had built during 50 years of systematic American financial development. The World War represented an existential crisis for international capital coordination that Jacob had created through European financial relationships that suddenly placed European capital on opposing sides of military conflict that would determine global political arrangements for generations. German capital that had funded American industrial development was now enemy capital, while British and French capital remained allied capital, forcing international capital to choose military allegiances that conflicted with optimal capital allocation that international economic development required. You see, Jacob's international capital networks had been designed for peaceful economic development that would benefit all participating countries through cooperative capital allocation that strengthened global economic capabilities. Military conflict was forcing artificial separation of international capital that served military objectives rather than economic efficiency, while requiring international capital to support military campaigns that would damage rather than strengthen global economic development. The political pressure was unprecedented and immediate. American newspapers were questioning Jacob's loyalty, while government officials were investigating international capital relationships for evidence of enemy collaboration that could threaten American military security. Jewish background was being interpreted as German sympathy, while international capital coordination was being viewed as potential enemy espionage that required government surveillance and possible criminal prosecution. But World War also created extraordinary opportunities for international capital deployment that could generate unprecedented returns while serving American military objectives that would strengthen American global influence after military victory. American military financing would require capital coordination at scales that exceeded any previous international capital deployment, while providing investment security through American military success that would guarantee debt repayment through military victory. Consider the capital requirements for American military financing that would enable American military capabilities for global military leadership. American military expansion would require over $25 billion in war financing, approximately $500 billion in modern money, while creating opportunities for international capital deployment that would establish American global financial leadership through military success that would enable American economic dominance. Jacob's strategic analysis revealed that American military financing offered perfect opportunity for demonstrating international capital's commitment to American success, while coordinating European allied capital for American military support that would benefit both American military objectives and international capital returns through military victory that would strengthen global economic stability essential for optimal international capital allocation. The war bond coordination strategy was unprecedented in international financial warfare. American military financing would be coordinated through international capital networks that could mobilize European allied capital for American military support while maintaining operational secrecy that would prevent enemy intelligence from understanding international capital coordination that was strengthening American military capabilities beyond enemy expectations. Jacobs' approach required delicate balance between international capital coordination and American political requirements for apparent domestic financial control over American military financing that national security demanded maintaining under ultimately American authority during military conflict, requiring American financial independence from foreign control that could threaten American military objectives during enemy pressure against international capital relationships. Here's what made Jacobs' war financing strategy revolutionary. International capital coordination would serve American military objectives while maintaining international capital returns through military investment that would strengthen American global capabilities, while providing international capital with unprecedented returns from American military success that would establish American global economic leadership after military victory. European allied capital coordination exceeded Jacobs' expectations. British capital provided systematic support for American military financing, while French capital contributed additional resources for American military expansion that would enable American military leadership for European military victory, that would serve both European allied objectives and international capital interests in global political stability. Russian capital cooperation was complicated by Russian political instability that was creating uncertainty about Russian military capabilities for continued allied cooperation. Russian Revolution was affecting Russian capital availability while creating opportunities for international capital deployment in Russian reconstruction that could provide extraordinary returns if political stability could be achieved through international capital support for Russian political development. American industrial coordination for military production created unprecedented opportunities for international capital deployment in American military manufacturing that would generate extraordinary returns while serving American military objectives. International capital would finance American steel, chemical, shipping, and munitions production that would enable American military capabilities while providing international capital with systematic ownership in American military industrial development. The steel production financing for military requirements enabled international capital to achieve comprehensive control over American military manufacturing while serving American military objectives that required steel production beyond domestic American capacity. International capital coordination provided American military with steel production capabilities that would enable American military success while generating sustained returns for international capital investment in American military industrial expansion. Shipping industry financing for military transportation requirements provided international capital with opportunities for American merchant marine development that would serve American military logistics while creating international capital ownership in American shipping capabilities that would benefit from American global trade expansion that military victory would enable through American global economic leadership. Chemical industry financing for military explosives and gas production enabled international capital to achieve systematic control over American military chemical capabilities while serving American military requirements that domestic American chemical production couldn't support at necessary scales for American military effectiveness against enemy chemical capabilities that required superior American chemical production for military success. War bond marketing to American investors created systematic American financial support for international capital coordination while maintaining American investor participation in American military financing that served both American patriotic objectives and American investor returns through military victory that would generate extraordinary returns for American military bond investments that international capital coordination was enabling. American worker coordination for military production required systematic cooperation between international capital and American labor for military manufacturing that would serve American military objectives while maintaining worker support for international capital operations that were enabling American military capabilities through superior financial coordination and industrial efficiency. European Allied coordination for combined military financing enabled systematic international capital deployment across Allied military requirements while maintaining coordinated Allied financial support that would enable Allied military victory through superior financial coordination that would overwhelm enemy financial capabilities through systematic international capital coordination for Allied military objectives. The profitability exceeded all previous international capital returns while serving military objectives that would establish global political stability essential for sustained international capital security. International capital earned average returns exceeding 35% annually from American military financing, while contributing to American military success that would strengthen global economic development through American global leadership. But war profiteering accusations were creating American political opposition to international capital that was benefiting from American military sacrifice, while American families were suffering casualties that served international capital returns more than American strategic interests that military victory was supposed to achieve for American rather than international capital benefit. Congressional investigations into war profiteering revealed systematic international capital coordination that was generating extraordinary returns from American military financing, while American military casualties were increasing through prolonged military conflict that international capital was benefiting from through sustained military financing that provided continued international capital returns from American military expenditure. Jacobs' response demonstrated sophisticated understanding of American political psychology during military crisis that required balance between international capital returns and American political support for international capital participation in American military financing that served American military objectives while maintaining international capital coordination essential for American military success. By 1918, 1 year before military victory, international capital coordinated through American military financing had achieved unprecedented returns while serving American military objectives that would establish American global leadership through military success that international capital coordination had enabled through superior financial capabilities that enemy financial resources couldn't match for sustained military competition. The war profits phase had demonstrated that international capital could achieve extraordinary returns while serving national military objectives through systematic financial coordination that strengthened military capabilities while maintaining international capital security through military victory that would establish global political stability essential for sustained international capital operations. But success was creating permanent American political opposition to international capital war profiteering that would influence American financial regulation for decades while establishing precedents for government oversight of international capital activities during national emergencies, requiring prioritization of national over international capital interests.